Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started.
Welcome to another episode of Kaizen Time. I'm joined by Brian Bride, Director of Payroll Operations. Brian, how you been?
I am pretty good. How are you?
I'm doing pretty well. You are employed here at Kaizen.
I am.
Yep. And you've been employed here for 2 years.
2 years. Yep.
2 years. Have you ever been on unemployment?
I've not been on unemployment, luckily.
Yeah. That's quite fortunate. But some people are. And that money comes from somewhere, right?
It sure does.
But that's not necessarily directly coming from you. Like if you employed me and I got fired or whatever reason, and I wanted unemployment, that's not directly coming from you.
No, it's not.
But part of it is.
Part of it is, yes.
Can you explain that? Like, how does that all work with the percentages?
I can. So
it sounds complicated.
Yeah. So the state unemployment is what we're talking about today, and the rate notice of what you pay. All the money goes into a pool, right? Now there are some credits and things against like how many claims you pay out. So we'll talk about that in a second. But basically, everybody pays to the fund. It goes through whatever process that the state is deemed to you qualify or not. And if you qualify, you get a certain percentage of your pay from before up to a maximum.
What do you mean process? Like, hey, they just take all your money that the employer provides and they process it. Like it just goes into a pool.
It goes in the pool.
Okay.
Right. And then when the employee that's no longer an employee applies, they take the money out of the pool to pay somebody, but there's also some credits against how many you pay out, right? So if people are filing unemployment on you, like you're just firing people left and right, you're going to have a higher rate because they're using more money to fund the employees that you keep getting rid of.
So let me pause you there.
Yeah.
That sounds like it would make it advantageous for an employer not to have people on unemployment.
Yes. It would actually behoove them to have people work for them for a long time, pay in and never make any claims.
Really?
Just like health insurance. Yeah.
So that's the ideal universe for any employer. Work for me for a long time, never quit.
Yes.
Okay. That's
it.
These are the things I don't know.
Yeah.
Okay.
Yeah.
So continue, please.
Sure. So for unemployment tax, so let's say, you get a notice in the mail. It's from the unemployment agency. You're like, oh, Jimmy left the company 3 weeks ago. He's probably filing for unemployment. Sorry to all the Jimmys out there. I was just picking a name off the top of my head. But it could be like your rate notice, right? So once a year, the state will figure out on various factors, depending on, how many claims you've had, how much you filed, have you been filing in time, have you been making your payments in time? And there's all these different, like, what would you call it? Like
calculations,
factors,
okay.
Factors into the calculation. So, some states there's 2 or 3, other states there's 4 or 5, right? So It all kind of depends. So let's say you get this rate notice. You're like, oh, okay, I have this rate notice. What do I do with it? I'm not sure. And then January starts again, right? When January starts, all the unemployment is annual. So it starts January 1st to 31st. There's something called a wage limit. In Illinois, it's about $14,000. So you as an employer only pay tax on the first $14,000 of somebody's salary.
Okay.
Right. So you have, a mix of employees. You got some salaried, you got some hourly, you got some part-timers. They come in and out. You're not sure. Right. So January comes along, you paid all your unemployment, last year through June. You didn't pay any in October or December because everybody was over the $14,000 cap. Right. So then January comes along and like, oh, you look at your payroll, like, hey, I'm paying all this extra tax. Was it for? Also, my unemployment wage base started again. Is this more or less than last year? I don't know. Let me look it up. I'm busy. I have 4 other things to do. I just don't worry about it. Because most service bureaus, us included, we go to the state and upload the rates directly from the state. So we have a process at the beginning of every year. We go to the state websites, upload the rate file for all of our clients that we have with them, upload our system. Boom. We don't really look at it. ADP, they have rate exchanges too, all the pays. So they're just downloading their file, uploading their books, and they're just going on, not really looking at it, right? Mm-hmm. So if you're not looking at your rate notice, there's a couple of CSRs here that would notice it like, hey, this is really high versus last year, right? Because they've worked with you for a really long time. They kind of know. But a lot of times it can be missed. So making sure you look at the unemployment rate notice, it doesn't bump up a lot for a reason, that you're not aware of is really, really important. So like I said, all the factors, right? It could be what kind of business you're in, right? So maybe you're a bricklayer, they have more turnover, right? Okay. So they would be higher. Maybe you own a fast food restaurant. They traditionally have like their turnover is 150%, right? Their unemployment is usually at a higher rate because people are leaving, filing for unemployment for a couple weeks, and then they find a different job and move on. Other things that can affect you is, let's say you haven't had a claim for a long time and then you start having a whole bunch of claims. You have like a pool in most states where it's like, all right, I know it goes in the general fund, right, to pay out, but some of this is your responsibility and you've started, your balance is lower with us. We need to raise your rate to replenish it because we project that you're going to have more people filing unemployment. So we need to collect more money. So that's how the rate goes up and down, right? You have a bunch of years where you have no claims. They still keep collecting money from you, but they might
at the lowest rate.
They might lower your rate, right? To say, okay, if they have a bunch of people file, we've collected so much, it doesn't matter anymore, right? So that's why some states can even go down to zero.
So you as an individual company could go to a much lower rate, even though other people in the state may have higher rates.
Yes,
this rate changes every year at a new year.
Yeah, January usually. Yeah. Unless you're like New Jersey, it's like in the middle of the year because New Jersey.
It's New Jersey. Yeah, right. That sounds about right. So essentially, again, going back and recapping this, ideally, you just have employees who work for you for an unbelievably long amount of time and then retire.
And not file a claim.
And never, ever file for unemployment.
Right.
But the worst case scenario is you hire somebody and you keep them just outside their probationary period.
Yeah, like their wage and their wage limit too. Like, they make, so let's say the wage limit is 14,000. Let's say that's 3 months of wages, right? You get rid of them right then. The next person you hire, you have to start over and pay again. So if you're firing people, and they're hitting that limit and then they're not working longer, it's costing you the most like it would cost
double.
You. Right.
Yeah.
Than if they stayed. Yeah.
So essentially you need to decide as an employer, hey, someone's brought on, you need to decide pretty early on if they're going to make it or not.
Right.
Because again, if they make it past that $14,000 mark and then leave.
Well, that's fine too, but it's before that. And then you have to hire and replace the person. Then you're like doing it twice as opposed to they say the whole time, you're only paying it once.
Gotcha.
Which is kind of like the same job. So
what else should I know about this?
Sure.
Because it sounds pretty complex, right. And I'm sure California has unique laws for this too.
They do. So
California does things their own way, I guess.
And so so if you get an unemployment claim, the best thing to do is to answer it right away. Right. Usually they'll send you a form. Most time it's online now where you're like, okay, this person worked for me. I fired them for cause or terminated them for cause, or I'm not going to reject. If you're never filling out the form, your rate's going to go up because everybody's going to get paid. Right. So let's say you terminate somebody for cause and you did a great job of documenting it. Chances are they're not going to get unemployment. Right. So if you fill it out and fill out the claim and say, here's why they're not working for us anymore, then you can save on that because you're not doing a claim. Right.
This is why documentation is really important.
Really important.
For unemployment purposes.
Right. So it fits everything, right? From, when they start collecting all that paperwork to filling out, any kind of disciplinary form. So you have all that paperwork in case they file and you want to fight it. Right.
So let me pause you for a second. Is that why places that have high turnover, so like a fast food place, would have an excellent documenting system for why you would be terminated?
You would hope that they do.
You would think they would.
Yes, you would think that they do. Right. Yep. So that's something to do. If your rate's always really high, that's a couple of things you can look at. Like, is it worth the cost to get? There's firms out there that unemployment cost management. That's kind of above like the level most of our clients are at. But larger firms definitely have these where they challenge the claims, they make sure they're managed properly, that they follow up on things like that. But that does cost, addition. So if you're a large organization, that may be something to look at. The other thing is making sure that you're making your payments on time, because if you're always late and you got fees and penalties, you're going to be paying more because they're going to say, well, you're late. You're a risk factor to not paying. They're going to increase that rate on you. So that's why it's good to have a payroll provider.
We're talking about the state.
The state, yep. So that's why it's good to have a payroll provider so that they impound every payroll and then remit at the end of the quarter. So the other thing to think about is there's something called FUTA, which is the federal unemployment system. And so what that does, that makes loans out to states when their systems get strapped. It was very, very used heavily during COVID, right? So, this happened in like 2008. It happened with the economy issue, and it happened in COVID again, where states will have to borrow to boost up their unemployment funds, right? Because they don't have enough to pay everybody.
Because there's more people
filing
and less people working.
And they're filing like they're eligible, right? Like there's a pandemic. There's nothing you can do. You can't do anything about, you have to shut your restaurant down.
This isn't, hey, all my employees decided to stop working. Right. This is, I can't afford to keep these people employed. So if your state has to borrow money and then don't pay it back in time, you get a credit on that for your federal unemployment. So most people pay federal unemployment per payroll, right? And that's 0.6%. So it's a very small percent because you get credit for paying into the unemployment system at the state. So it's called a FUTA reduction credit. Kind of complicated, but payroll companies handle this. If the state owes money to the federal government at the end of the year, you have to pay the difference. So for example, California still owes money from COVID, right? So their FUTA reduction went from 5.4% down to 4.2%. So what that means is it's 1.2% of the reduction you have to pay back. So most FUTA is 0.6%. It's only the $7,000. So per employee, that's $42 on average, right? So every person you employ, whether they work a little time for you or, once they get the $7,000 in wages, it's $42. If they only get 1,000, it's $420 or whatever, right? But California, this bad math, but $700 $420. California still owed the government, right? So they had to pay an extra 1.2%. So any California client that we had in November, December, we have to collect that from them. So if they had hit the wage limit and paid $42, we need another $84 from them. Oh, geez.
Right. So, you got 6 or 7 employees, that's $500 that you weren't really spending, or you got more, it's more money, right? Imagine a large organization in California, like what they got there, In-N-Out Burger out there. Imagine how much they were paying extra.
That sounds terrible.
Yeah. Because California didn't pay their money back. So you owe because you were getting credit on the money before.
So on top of just being a place that has high turnover, they're also getting hit because they have to pay back all the money from McDonald's. That they were getting credit. Not McDonald's, California.
Right, that they were getting credit for the government, but when California didn't pay that loan, like, you need to pay us now. So.
What else do we need to know about this?
Yeah, you don't really want to mess around with unemployment. If you're not making payments, it's just like they're usually in a Department of Labor, Department of Workforce Development somewhere. So they're related. So if you have a Department of Labor issue, you probably got an unemployment issue tax as well, right? Because they're going to be making sure you made that payment. So that's almost guaranteed that's going to happen. They're going to.
So this falls into another one of those categories of compliance. Yes. And if you mess with this, there are serious consequences. Yep. Okay. Anything else, Brian?
No, it's a pretty complex topic. So if you have any questions, you can reach out or call your payroll provider or accountant. They'd be happy to kind of walk you through it.
And there are payroll systems like iSolve that we use that address this, right? Like it's all built in.
It's all built in.
Perfect. Thanks, Brian.
Yep. Thank you.
You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.